One important piece to the mortgage puzzle is you need to understand is by increasing or decreasing your interest rate, you increase or decrease closing costs on a loan. That's a general rule. Okay. Well, what you do is you use that to your advantage. When you lock a loan, it's all based on risks on the back end. The institutions that say you can lock, they say, we're going to lock you in at 785 or whatever the number is at 30 days. That's what we're going to guarantee you. And if it goes up, that's our loss. On average in Utah, a mortgage loan is only on the books between 4 and 5 years before somebody refinances or before someone changes.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Rob, you've been in mortgages. You were just telling me you've been in mortgages for
32 years.
32 years, live up in northern Utah. What else have you done throughout your career? Like anything, that you care to share, noteworthy?
Oh, sure. My greatest accomplishment is I've been married to my wife for 32 years this year. And just been a wonderful 4 kids and 4 grandkids, and all my kids are married, and it's been really neat. But yeah, no, mortgages has been my life. I started off as a real estate agent with my dad, actually. And I learned the ins and outs of mortgage because in mortgage it's very technical in terms of don't promise something you can't do, because that ruins your reputation awfully quick.
Yeah. And
what happened was, getting into the mortgage business, my father and I, one month, we sold 25 homes, and we were so excited because we had such a great month. And the lenders that we were using at that time would say, no problem. Yeah, you're looking good. These are all going to close. And then at the end of the month, what ended up happening is that 8 of them got down to the day of closing, and they said, oh yeah, sorry, we can't close it. It doesn't work. And the way I got in the mortgage business is I said, that's ridiculous. I was graduating from college in finance. And I said to my dad, I can go do this better. This is ridiculous. You can't leave people hanging. And so I became a student of the game. So I walked into Valley Bank and Trust at the time. And I said, I don't know anything about mortgage, but I'll be one of your top producers. And the manager took pity on me and hired me to join him. And the first year out of the gate, our average loan size was only $75,000, but I ended up closing $16.8 million. And it was just really, it started off really great. But I love being a student of the game.
Yeah.
I started off as an originator, doing loans. I've been a branch manager, to an area manager, to a regional manager, and now I'm blessed to be an owner in Momentum Loans.
Well, congratulations on that. When Ben told me that you were coming to town, I was excited because he told me that you've had this vast experience, not only in originating loans, which I think is, it's not hard to find somebody that has good experience in originating loans in Utah, right? But somebody that has been on that executive side of the teams in the business. And there's nuances in the mortgage space that go on behind the scenes, right? Everyone thinks like, you show up, you tell them what the parameters of the deal are, and they send the check in and you start making payments, right? Right. This easy peasy thing. And I think even some mortgage lenders or, loan officers don't think too far beyond that.
Right.
But there's all these nuances that happen behind the scenes. And how does this whole mortgage system work in the U.S.? Because the U.S. is somewhat of an anomaly.
Yeah.
If you look across the rest of the world, I think the only exception is maybe Denmark. I think it is. They don't have 30-year fixed mortgages, right? This is a unique thing to the U.S. And so what it leads to is a lot of questions that people have, or misconceptions, or just a general lack of understanding. So one of the big questions that I always get from people, as an example, is like I have a friend recently that called up and he's looking at buying a home. And this individual said, I'm going to use one of the institutions that caters to veterans, and because that's where he does his banking. And he says, and so that way my loan doesn't get sold a bunch of times. And I'm like scratching my head. I'm like, they're going to sell it probably. like almost for sure at some point they're still going to sell your loan. He's like, oh, I thought if they originated it, then, I just always work with them. And so in his mind, if he went to like a mortgage shop or a mortgage broker or something, then that they're the ones that sell it. And that's where kind of this friction point, starts at. And it's entirely not true, right?
Right. What happens is you've got different companies that, yes, they might service loans. Like maybe a bank or credit union will service some loans, or maybe some of the big institutions across the country will just, I'll service loans. But eventually the servicing capacity dries up. Mm-hmm. And so what happens is in the secondary market, depending on how loans are performing, they'll say, hey, you know what? I need to get some extra cash. So I'm going to contact this other person over here, see if they want to buy these loans, and they will sell them. In every contract I've seen for the last 15, 20 years, it always says we reserve the right to sell your loan.
Yeah. And
even if they say, yeah, in general, and on your closing document, it will say that we sell X number of our loans.
Yeah.
And so it's not a guarantee that they're going to keep your loan, but some lenders will say, yeah, there's a really good chance, but it really depends on the market, because as rates go up and down and fluctuate, that's really what dictates what a lender does with the loan.
Yeah. Well, and I think we can get into that, but they're managing portfolios just like anyone else, right?
Exactly right.
People forget insurance companies the same way, right? Like, so what they're managing is a little bit different, but they're managing a portfolio of risk and yield and expected returns, for dealing with it.
That's right.
So let's go through the process really quick. So Johnny comes in and starts the process to get a loan. He meets with the loan officer, and the loan officer says, yeah, everything looks great. You got a good stable job. You've got low debt, and, you're wanting to buy something. You've got a good down payment, whatever. This is going to be we're going to button this thing right up. No problem. So he goes out and gets a home under contract. And then what? Where does this process really start? What are the inner workings? What starts to turn in the background at the mortgage company?
Well, so for instance, the loan officer has access, and it depends. So let's first of all define a couple differences. First of all, a mortgage broker is someone who says, I'm going to look at your loan. I'm going to try to shop at a bunch of different places and see what I can get.
Okay.
For this loan for you. But they have no underwriting. They're not decision makers. They're just brokering the transaction. Yeah. Then you've got a mortgage banker who actually funds loans in their name, and they contract after the loan is closed with different banks and different institutions to sell the loan to them at a later time. So, and then you've got some different banks and credit unions that decide to either hold loans or not hold loans. And so there's those three pods basically.
Okay.
So in general, when someone comes in and applies for a home loan, it really has to do with the relationship they have with the real estate agent, with the customer, previous experiences. What we found is the majority of consumers still, even though they get all the information online, they will still ask their friends and family who they trust.
Yeah.
Okay.
Sure.
And if they do that, generally they have a good experience. Okay. But to answer your question technically, so you get pre-qualified for a home loan. You say, go out and find the home. And then there's a negotiation process that takes place when you're buying the new home. What I like to always say is you really need to talk to your mortgage lender to tailor make the loan for you, to use all the bells and whistles to benefit you more long term. And I'll give you an example. Right now in this market, there's builders and customers that are saying, my home's not selling as fast as I want it to sell. What incentives are there that will help a buyer get a better situation?
Yeah.
And that can range from, and so one important piece to the mortgage puzzle you need to understand is by increasing or decreasing your interest rate, you increase or decrease closing costs on a loan. That's a general rule.
Okay.
Well, what you do is you use that to your advantage. As an example, I was talking to a builder the other day, and I said, so how much are you incenting the borrower to help them qualify for a home loan? And he said, honestly, he says it's up to 6%. So 6% of the sales price, I will contribute to help get the borrower in a better situation. Now a lot of borrowers will not even understand what that means. They'll go, well, what does that mean?
Price discount or something.
Yeah, it's just a price tag. But what that means is most borrowers worry about how much money I have to come up with out of pocket to close the transaction and what the payment is.
Sure.
Those are the two main drivers of almost every real estate transaction for loans. So then you start talking to your loan officer, and the loan officer says, well, if the seller will pay that kind of money, why don't we take, generally closing costs on a home loan are anywhere from 2 to 2.5% of the loan amount, generally. But if the seller is willing to pay an additional 3 to 3.5%, then you can use the rest of that to buy down the interest rate.
So they cover your closing costs, plus you can buy down the interest rate.
Yes.
Yeah. Okay.
And so the consistency is awesome, because then you're tailor making the loan, and then all of a sudden their payment goes down by $400 a month or whatever that number is.
Yeah.
It's a win-win.
So you get through that negotiation, but then the inner workings of the bank, like how does that origination process start to look on the backside?
Good question. So the backside is that the loan, the loan goes to a processor. Processor scrubs it, gathers all the documentations, the paycheck stubs, W-2s, those types of things, orders an appraisal. The appraisal comes back. We order a title report to make sure there's no liens or judgments against the property, and make sure that everything's clean that way. We package it up and we send it to what we call an underwriter. An underwriter looks at the guidelines for, there's three main aggregators for mortgages. There's Fannie Mae, there's Freddie Mac, and there's Ginnie Mae. And Fannie Mae and Freddie Mac are under conservatorship from the federal government, and Ginnie Mae is the federal government. Those are the HUD loans. Okay, so you look at the guidelines that are presented for mortgage loans and make sure the underwriter makes sure the loan fits within those guidelines. Debt to income ratios, qualifications for credit, that type of thing.
Why is it so important that they make sure that they follow the federal government's guidelines?
It really has to do with loan performance. One of the things that the mortgage industry has been really concerned about for years now is affordability of homes and affordability of people's budgets.
Okay.
Because if we don't have guidelines around that, you may say, I want to have $1 million home.
Yeah. And
then your payment's way too far out, then you got a foreclosure, and then the home has to foreclose.
But Rob, it's you're the money, your money, or the bank's money, right? It's your guys' money. You're originating the loan. Why do you have to have why do you just follow the government's guidelines because they say this is probably just some good guidelines? It's a good rule of thumb.
It's a good rule of thumb, but the guidelines are based on the investors that buy loans, what the risk is that they're willing to take. So mortgage-backed securities have to do with investors that say, yeah, I'll invest in mortgage-backed securities. That's how you get your funding for that. And if you don't follow those certain guidelines, if you, for instance, delete a guideline, that increases the risk to that investor. So the investor just now says, I'm not going to do it for that. I'm going to have charge a premium for that. Yeah. If you're going to delete a certain guideline.
So if you don't follow the government's guidelines, the government isn't going to issue their, implicit guarantee.
Correct.
And on the loan.
Yeah. So for instance, FHA loans, there's FHA mortgage insurance that's purchased to protect the lender from a potential default. But that only comes into play if you're following the right rules to the loan.
And make no mistake, right? Like the lender in this case, it starts out at the bank, but as you described, it ends up being in a mortgage-backed security that likely then ends up in a mortgage-backed security index fund, and all of a sudden it's in, Johnny and Susie's 401k.
Yeah,
right.
Absolutely.
And they're the ones that are actually the lenders in the end. So, okay, so the loan processor is starting to work on the loan, and they're checking to make sure that the loan is going to conform to the government underwriting guidelines to make sure that these government-backed loans are going to be marketable to the investors after closing. Where does the rate lock process come into place?
So the rate lock process comes into place where you've chosen the loan product that you want to have. most lenders have a choice of different institutions that will you can sell the loan to, and those rates come out every single day. In fact, sometimes minute by minute they can be changing. So if I'm going to lock your loan, I pull up the rates for the day, and I also check the market to see how volatile the market is being.
Sure.
Because sometimes you see the market's trending downward, and you say, we're going to hold off on locking you for a second. But you don't hear that often with unseasoned professionals, because they don't understand the market. But you go to the secondary market and you say, okay, here's what so-and-so lender is offering for the day. This seems to be the best rate and best terms. This is what you could offer to the customer. And the customer says, oh, that sounds good. And here's your repayment's going to be, and you walk them through it. But generally, it's a process of just making sure you're an advocate for the borrower to give them the best terms available based on that day.
Okay. And so why do you guys lock a rate, right? Like why does it become, so hey, today I can lock at 7.85, but interest rates, although they're range bound, they're typically pretty volatile.
Yeah.
And so, man, 2 weeks from now, before we even buy the house, rates could have been down at 7.65. Why? So can you adjust me down, or why is that process the way it is? How does that work?
That's a good question. So what happens is that when you lock a loan, it's all based on risks on the back end.
Mm-hmm.
So the institutions that say you can lock, they say, we're going to lock you in at 7.85 or whatever the number is at 30 days. That's what we're going to guarantee you.
Mm-hmm.
But if it goes up, that's our loss.
Yep.
So I always ask the customer, Mr. Customer, I know rates have been going up or down. What are you comfortable with? Because we can lock you in, and you can have no worries, and then if it ever goes down enough to where we can refinance or relock it, generally there's a provision that you can, once you lock a loan, if it does go down at least 1/4 to 3/8% lower than what you're locked at, generally there's a renegotiation that can take place on most loans. But again, that's not guaranteed.
Mm-hmm.
And so it's kind of an assurance to the borrower that, okay, this is what you're committing to. You're going to close in 30 to 45 days. Do you want to risk the market? Because if the market goes up and you don't lock,
you pay more.
You're going to pay more. Let's say you're $400 a month more. How would that feel to you? Oh yeah, I don't want that. I like where I am now. So the provision to be able to lock, and there's 15-day locks, 30-day locks, all the way up to 60 to 90 to 120-day locks.
Yeah.
That are generally, now there's some extended locks out there, but generally the extended locks are they price them higher in rate anyway.
Intentionally.
There's
an explicit hedging cost
totally. That's right.
for the mortgage market. Yeah.
That's right. So, generally if the customer's within 30 days, I generally say, you know what, if you like what you see, if you like what the numbers are, let's take the worry away and let's get it locked.
Mm-hmm. And so, to be clear, like the reason that you can lock is you're making a trade with you're making an agreement with the bank that's originating the loan, who's then making an agreement on the back end to the people that are potentially going to buy the loan, to say, look, we are going to originate this loan at $500,000 at 7 5/8 or whatever.
Yeah.
And interest rates could be different a month from now. And what we want back is we want our $500,000. We want you to buy this loan at par at $500,000. And, that's what we want back. So if rates go down to, 7 1/4, the investors buying the loan are going to get a sweet deal on it. Right. Yeah. And if rates go up, they're paying you a premium all of a sudden for the loan because it's got a lower interest rate in an environment that, they could have originated higher.
So so what you said is very, very critical. So the investor, I'm giving you a loan at 7 3/4, let's say.
Mm-hmm.
If the rate goes down because the market goes down, okay, then that investor is making less money from 7.5 to 7 1/4.
Yeah.
So there's different dollars associated with what they're willing to do that loan for.
Yeah.
So to lock, if I'm locking at 7.5%, that investor is saying, yeah, I'll give you that money at this price.
You're shifting. Yeah. And so you're shifting the risk to them,
Yep.
but you're shifting the possible reward to them
Totally.
as well. And that's why they're willing to take on the trade.
Totally.
Now, I can tell you that on the back end, the professionals at those institutions then go and hedge their own risk in the options
right.
markets.
That's right.
They're re-hedging their own risks. But I will also tell you that that's not free to them either. And they actually pay a pretty good premium on an annualized basis to hedge that risk.
That's right.
So rates locked, it's through processing. What are the other mechanics that come into play? Like, so now you're just waiting it out, appraisal comes back, it's good, so you guys are like, yep, clear to close. And you're going to go close your house, going to go show up on Wednesday morning to sign and close on the house. Who's actually getting the money and to where, and how does it kind of go from there?
Yeah. So from there, so if you're dealing with a direct lender or mortgage banker, generally the loan will be closed with the company that you're closing with. And that goes for most companies or mortgage bankers. Unless you got a small mom and pop broker shop, it's generally a mortgage banker that you're dealing with. So on a mortgage banker, the loan closes and funds in the name. And then usually within the 30 days after that closing, that mortgage banker hedges a bunch of loans together into a pool. And that pool is shopped. They call them bid tapes. They're shopped with a bunch of the different investors that are buying loans and saying, I've got this bulk number of loans on this type, like whether it's conventional, whether it's VA, FHA, whatever the types of loans they're bulking, they'll bulk them all together for the month and they'll say, yeah, we're going to sell them. What are you going to bid for this? Mm-hmm. And the lenders bid on buying bulk loans. And so whoever wins that bid is generally who the servicer is that's going to buy that loan.
Okay.
And it really has to do with what the market's doing, what the different appetites are of the different lenders that are buying the loans.
So the mortgage bank that is going to originate the loan wires $500,000 to the title company. Yep. Where you sit down at closing and title company gets the money, they pay off the seller, they record it at the county, and to you, you're like, as the home buyer, you kind of wash your hands and you got new keys and you're like excited for the day. Yep. And for a brief period of time, like your mortgage is owned and theoretically serviced by the bank that just originated it with their $500,000.
That's correct.
So, and that's where you're saying now it goes to bid tape, where you guys would take and start pooling mortgages together and saying, okay, collectively, we've got, I'm just pulling numbers out here, 100 loans that we originated this month that have an average weighted coupon or yield of this much. And, these credit kind of factors in general.
You know the general lingo. I like it.
And yeah. And so we want to hit the bid tape and see who's going to buy that, and so now someone on the secondary buys this initial pool of loans from the bank that a home buyer just originated their loan to, and that's how they get it off their books, right? How long does that normally take?
Generally, that's usually, so there's a process that has to happen, and that is when you decide that you're going to sell, you have to send a goodbye letter to the current borrower that you just closed the loan for, saying, we've sold your loan to X company.
Okay.
And the borrower then will receive a letter from the company that bought their loan.
We just bought it.
Sure. And hey, nothing's changed. Here's how it's going to work. Here's your new contact, and just walk you through the process. Years ago, that used to be a horrible process.
Yeah.
But now it's gotten really, really good.
Yeah, my loan just got sold again on my house, and I didn't have to update my auto pay.
Yeah,
sweet.
Exactly.
But so like you just, though, as the bank, just sent $500,000 to a title company on something where you locked for the borrower, and you guys took on that risk of, hey, if interest rates go down, we're going to make a little bit more juice on this loan, but if interest rates go up, then we're going to lose some money probably on originating this loan. So we want to get our $500,000 back from a secondary market. How long does it take the bank to actually get the funding from the secondary market to recuperate their $500,000 that they used to originate?
Usually the warehouse banks are about 7 to 10 days.
Okay. So you guys are taking a bit of interest rate risk for 7 to 10 days. Is that something that most banks are hedging that risk or managing that risk themselves, or?
It depends on the size.
Okay.
It depends on the size. There's hedging companies that do it for them.
Okay. Outsource it.
Yeah, they outsource it. But most times you're hedging it internally and understanding what your risk is and going for it.
Here's an interesting question. I don't know the answer to this question at all. So when somebody trades TBAs on the open, TBAs are over the market in the forwards market, so they're OTC. But when somebody's trading a TBA, at what stage in the process is that loan normally? Is that still with the originating bank, or is that hitting secondary market that it's now getting packaged into the MBS and so it's trading TBA?
It's a secondary market.
So it's in the secondary market. And so what are the common names in the secondary market that people would maybe be familiar with? They go like, oh, so that's why it ended up there. That makes sense.
Really, that's the hard thing is that what people need to do is there's different, they call them spec pools.
Okay. So
there's different specifications on different loans that certain companies are looking for to service. As an example, there's quite a few banks that, because they like short-term money, they will come in and they want to service 15-year loans. Yeah. They say, hey, that's a shorter window of risk. Yeah. So we would love to buy that loan and we'll service. And so what they'll do is what they call pay up for that. Yeah. They'll say, hey, you got that. We'll pay you a little bit extra money for those loans because that's what we want to have on our books.
Yeah. They'll pay a premium for shortened duration risk.
Yep.
Yeah.
And so these spec pools have to do with the types of loans being originated and what the analysts are believing how long is like, for instance, in Utah, the average time now, since rates have gone up, this has gone up, changed, but on average in Utah, a mortgage loan is only on the books between 4 and 5 years before somebody refinances or before someone changes. That has everything to do with how long the investments, the investors want to hold on to a mortgage or how much they're going to pay for a mortgage. And so, I always like to say, you've got to, by state, depending on the state, like Utah is very notorious for refinancing. Some other states, they actually, there's more premiums made on their loans because people are holding on their loans longer. And there's also some states that are worse than Utah in terms of turning their mortgages. And so those same thing, they pay less for those.
This sounds a lot like actuaries running the book of business at a life insurance company.
Oh yeah, very much so.
We got a lot of diabetics on the book. We want to price that different, or people that have had heart conditions, or we don't have a lot of that, so let's price that low and get some more of that business in. They're managing their book of business, so it goes back to what we were talking about earlier. It's all about managing your portfolio.
Totally is.
And the dynamics and characteristics and factors that you want to have exposure to or limit exposure to, and what your risk appetite is or your business model.
Absolutely.
That's the financial world. Regardless of kind of the segment you're in.
Yeah.
Okay. So what are those companies though? Because I believe their names people are somewhat familiar with, right? At this point, they might have heard of them.
So, I mean,
what are the big ones?
So you've got, Bank of America, Chase, Wells Fargo. You've got some of the big U.S. bank.
Yeah.
You got
the big guys.
PennyMac.
Yep.
PennyMac was an offshoot of many different companies over the years, but PennyMac's was created as a servicing wing. But you got companies like that. Mr. Cooper is another one.
Yeah.
But these are entities that have chosen to be servicers.
Yep. So they buy the loan initially on bid tape.
Yep.
And they get this pool loans. And then now that they have it, they have kind of two things they need to do, right?
Yep.
They, from what I'm understanding in this conversation, they need to both start servicing the loan, right? Collecting monthly payments, sending notices, getting people access to online portals, making sure the loan's paid. And then they also, though, don't necessarily want to own the entirety of the loan, right? So they are going to sell the actual debt obligation of the note into, right? They're going to pool it. They're going to pool it into a mortgage-backed security, right? And then put that mortgage-backed security together and sell it into the market, right?
That's correct.
Which it then, for anyone that isn't thinking ahead of me at this point, gets pooled up typically and will get bought up by, not super common that people are going to go out, especially on the retail side, and buy, like a Ginny 5 or something, right? It's going to get put into an index and then get picked up by a mortgage mutual fund or mortgage-backed mutual fund or Vanguard fund or something. And all of a sudden it winds up in your 401k. There's other, institutional investors of mortgage bonds, obviously, but
totally. One of the things that we got to remember is that we mentioned Fannie Mae and Freddie Mac.
Yeah.
Okay? Fannie Mae and Freddie Mac, they have the rules of engagement for the investors. There's cases where we're selling loans directly to Fannie Mae and directly to Freddie Mac. Mm-hmm. But Fannie Mae and Freddie Mac aren't servicers. So what'll happen is a mortgage banker will sell it to Fannie Mae or Freddie Mac if they're direct lenders to those entities.
Yep.
They'll sell them to them. Then Fannie Mae and Freddie Mac will package that together, and they'll contact the bank and say, we've already got the investors all covered with everything.
Yeah.
But we want you to service it as part of your servicing, and for that we're going to pay you X number of dollars per year to service that loan.
Yeah. Yeah, because even when they buy it on the secondary, right, and they sell off the actual note obligation into the mortgage-backed security, they're still retaining the servicing aspect of it. Yep. And so they're making sure that you make the mortgage payment that flows to them, and then they make sure the payment gets made to the bond, and the bond holders get made whole, whether that goes into people's 401ks or their brokerage accounts or whatever. And so they just keep part of the yield or the fee or the interest payment people are paying to provide that service of servicing the loan. But they don't actually own the loan anymore. They just own the right to, hold you accountable to it. Really, it's kind of what servicing is, right?
Right.
And so when people say, "Oh, they sold my loan again," well, no, your loan is fractionalized and getting bought and sold every day all over the place. But what they did was sell the rights to service it, or the obligation to service it, right?
And that provided stability for the home buyer.
Yeah,
the home buyer was so worried about, okay, if my loan gets sold, oh my gosh, what are they messing? I don't want my personal finances messed with.
Yeah,
and there's honestly no fear in that anymore, because what happens is there's laws around you cannot change.
Yeah.
In fact, they've even said within the first 60 days of a transfer, if something goes wrong where a payment gets missed, they can't ding your credit.
Yeah.
And those little things they put in place to protect the consumer, because this free flow of money actually helps keep rates lower.
Yeah.
Liquidity. It's liquidity.
Yeah.
So.
Well, what's unique, again, it's a uniquely American thing.
Oh, it is.
And so if you think about, if we didn't have this, if we didn't have the securitization of the mortgage-backed security, right? And, people's average mortgages weren't getting securitized this way, it would really be, your local bank is going to give you a mortgage and you got to make payments soon for 30 years. Well, if you think about it, there's a lot of risk in that, a ton of risk, right? Because the amortization of the loan is going to bring down the effective duration on the risk of the note, essentially, but it's still like a pretty long-term asset. And so for a small community bank to say, well, we're going to start issuing loans to all these people in our community, where if something happens to the local economy, we're going to have a ton of geographical risk in our book of business and on our balance sheet as a bank. Plus, we have all this interest rate exposure that if interest rates go up over the next 10, 15 years, we could get wiped out. Yep. And, for anyone that's not familiar, that's sort of what happened. Way longer story, and I could do a whole episode on it. But that's what happened to Silicon Valley Bank in 23. Yep. And, that would really be dangerous. So what it would cause is banks wouldn't say like, okay, we can't give you a mortgage at 7.5% on this fixed 30-year mortgage. Your interest rate's, 19 is really, you know what I mean? Like the risk would be so much higher, it would mandate this way higher interest rate. And so it is this securitization process that allows, and quite frankly, in my opinion, the government giving the guarantees on the removing that credit risk from the investors. And that allows for us to have, as high as they seem today, really reasonable, really cheap mortgage rates actually for what you're actually getting. And I think the effects that has on the housing market long-term is a whole nother conversation. But we get pretty cheap long-term money in the U.S. because of that. One of the trade-offs we have to deal with is, well, they can sell the servicing of my loan and I got to set something up, an auto pay or a new login, or I get 2 tax forms this year or whatever it might be. It's actually a relatively minor inconvenience.
Yeah, it really is. And one of the things that we always have to remember is it's just liquidity. Banks get loaned up. Mm-hmm. They're governed by how many deposits they get and where they can get their money and at times. but I'll give you an example. So one of our banks that we deal with, occasionally they'll come in the market. Hey, we want to buy this many loans. Yeah, and it has to do with their CRA money. Okay, CRA money basically has to do with community lending.
Okay,
and so they'll say, "Hey, we're gonna give a discount on these parameters of loans, and we want to buy this many loans. Mm-hmm. And once you hit this total, it's done."
Yeah.
Okay. So we just finished one of them, and one of them was that bank was offering 0.75% lower than what the market was.
Mm-hmm. Wow.
Okay, for a certain parameter of loans. Well, we have to be better as an industry about finding those different little niches, because it just helps our borrowers so much. I mean, the borrowers that took advantage of that loan, just off the books excited, because it was that much lower.
Yeah, 0.75% is pretty big difference.
Oh, it's dramatic. Yeah,
that's huge in interest rate land.
Yeah, it really is. So the other thing that's happening a lot right now, and we've seen it just in this last year, the sweet spot where people are going to start buying and selling more homes. Like we've had a 3-year run here where the rates are between 6.5 and 7.5, and that's really where the range has been. It did approach 8 a little bit, but sure, really that's the range. Well, long term, it's actually a healthy market if you look at the history of mortgages.
Yeah.
But the thing that we're battling right now is housing price. We can take a whole nother segment on housing prices and how that affects payments, all that stuff. But so what the builders and things are doing to combat that is buying rates into the 5s. Some of the things that we're seeing right now is to get the market moving. We got a group that's sitting on the sideline right now that has 3% mortgages, 2.5 to 3% mortgages. They never want to give that up.
Yeah.
But then there's also a pent-up demand that says, I really need to buy a house. And so that's why you're seeing a push right now to try to buy loans into the 5s, even into the 4s. There's some that are buying into the 4s right now.
As some people are starting, there's more robust debate, I think, at this point in the institutional community about the direction of rates in the next couple of years. And so it has the pricing of rate buydowns come down with the perceived notion that rates in general could come down. Because if you think rates are coming down, you sort of could afford to give a better deal on the cost of the buy down on the front side. And
it's actually reverse to that. If there's a more steady market where that fixed rates are going to stay for a longer period of time, at, let's say, like right now, the forecast, I'll give forecast for the end of the year. Forecast for the end of the year is we're supposed to bounce between 6.5 and 7%. That's where we're going to be. Low side 6.25 for a 30-year fixed.
On the National Mortgage Index, or
okay, that's what, and that's according to.
It's optimistic.
That's also like the University of Utah does a big workup on it, and also the Fannie Mae and Freddie Mac, they do some national statistics, but they're saying the forecast is rates are going to stay between 6.5 to 7%. That's what you're going to see. Knowing that's the case, and it's forecasted out through the end of the year, then what happens is investors go, well, okay, if that's going to be that stable, I can now offer a better term to buy it down.
Yeah.
Because I want those loans. If they know the rates are going to come down anyway, they don't have to offer as much. And so it's the stability of the market actually lends itself to allow you to buy down a little bit lower, it just makes it more stable.
Well, that's in the derivatives land of options pricing, you look at implied volatility, right? So anytime implied volatility comes on, your options pricing gets cheaper. So I imagine it's probably somewhat similar.
Very similar. Well, like recently, there's some new product coming out. And we haven't seen it for a while, but it's a 3-year fixed rate loan and a 5-year fixed rate loan, which is fixed. It's amortized over a 30-year loan, but it's fixed for 3 years and fixed for 5 years at a certain time.
And then it goes to adjustable, or?
Yep. Then it converts to an adjustable.
So that's it's kind of back to what they were issuing in the early 2000s, right?
Correct.
5-year arm,
Correct.
3-year arm, right? It's got a fix and then it goes floating.
But see, on a 3-1 arm, you can actually get down to as low as 4.25% right now. And
I think in the early 2000s they called that teaser rates.
They did, and that's what's funny about the new arms. Like the teaser rates were on the 1-year loans, and it was crazy. But these 3 years and 5 years, they just basically price and say this is what it's going to take to get to this loan.
Yeah.
And the good news is it allows the borrower to qualify at that low rate, which lowers their overall housing payment. So
yeah. Do you think that introduces a level? Are those government-backed loans? Is that an FHA program?
FHA program.
Oh,
yeah. It's interesting to watch because
it's a little spooky.
For a long time it hasn't been an option. But if someone is saying, "Hey, I want to get in," and the good news is that let's say you got a 6 3/4 rate right now.
Yeah.
If you bought that loan down to a 4.5 or 4.25 to 4 3/4 in that range, the maximum change per year is 1% per year. That's on an adjustable rate loan. So after the first 3 years or first 5 years,
they only let it go up 1% per year.
Exactly. For a lifetime of 5% higher, worst case. Now the 5% higher, that's a risk, and that's kind of where it gets a little bit dicey.
So you could get as high as on a 5-year program like that, you could get. Originally, you're saying you can originate something like let's call it 4.5.
Yeah.
You could get as high as 9.5% 10 years from now.
10 years, yeah.
Okay. Yeah, that's a bit more moderate than the original.
It is. The other stuff you're talking about, you're right. It's
yeah. It's an uncomfortably high rate, but that probably gives people a little bit more opportunity rather than a snap to reality.
Right.
So, it's interesting. The original arms, that probably is the way that like mortgages theoretically from an investment perspective should work, is something more like that. The problem is that it doesn't incentivize homeownership the same way.
Exactly right.
And if we were on that kind of system, then you would still be buying really cheap housing. Right. People wouldn't have the equity appreciation in homes that they do. And that equity appreciation, the government has determined it's good for stability of communities in the country. And thus they want to incentivize it. And they sort of implicitly suggest that, your home value should go up over time. And this 30-rate fixed mortgage that they now, back provides a really affordable way to do that, like relative to what it should cost in totally free markets that don't have government intervention.
Yeah, it's true.
So
true. Absolutely right. Well, and up until a few years ago, the government the reason rates popped up so fast, so a few years ago is because the government for the longest time was buying mortgage-backed securities to drive the rates down.
Yeah. I thought it was just because Barry Habib wouldn't stop saying that they were going to lower it. And so I thought they were just calling his BS.
Yeah, that's fair. That's fair.
Yeah, the Fed, well, that goes back to liquidity, right? So if the Fed stops buying them, you Yeah, quantitative easing is a whole nother
topic.
That's a whole nother topic. But they came up because it was unsustainable to keep them that low. Right. So you can't expand the money supply that quick and keep them that low, unless you're Japan, apparently. But that's a macro conversation for a whole nother time. So, well, Rob, I appreciate you sharing the insights on the back end of mortgages today for us. Hopefully anyone listening was able to kind of realize, like, hey, there's some complexities here that the banks deal with. Yeah. This is something bigger than me. And, it's not me versus this loan originator across the desk or a banker, or, these guys are jerks if they sell my loan. And it's not, hey, it wasn't your loan officer's decision or fault, that 3 years from now they sell it to somebody else. And the process, they've tried to make it smooth and is as little as impactful on the borrowers as possible. And also, like, I'll just add the caveat once again, like, we have unusually good terms on mortgages as high as the interest rates may feel today. Yeah. My personal belief is that it's a broken system, but it's nonetheless the system we live in. Mm-hmm. And so you have to participate in the way that you think is going to help you, the best towards your own long-term success. So,
yeah. And what I would say to our listeners would be, have faith in the process, understand what you're getting. What is your total payment? What is the total cash required to close? Does it fit your budget? Does it make sense for you to move forward to create your financial budget for the future? Yeah. Any financial planners that are working on people's futures, that's what we do in a sense in terms of creating mortgages. Mm-hmm. Is we try to say, what are your financial goals, and we try to match it up accordingly. And it's really important, honestly, that financial planners and mortgage industry professionals collaborate on some of that.
Yeah. We love when clients make sure to talk to us ahead of time so we can help collaborate with their bankers, their mortgage loan officers, whoever they're working with on all that kind of stuff. I have clients that call me up before they're going to buy a car and say, hey, I'm buying a car, and what do you think rates are at right now, and what's going to be fair. And I've saved clients thousands and thousands of dollars because they didn't get taken for a ride down at the dealership in the finance office, right. And we were able to equip them with some good baseline knowledge. I could check rates really quick for them. Oh. I've saved people money on mortgages that way. You can save a lot of time and hassle by just helping your professional team around you communicate with one another.
Absolutely.
Usually the ones that don't want to communicate are they're not trying to work in your best interest, typically, is what I found. So, you want good professionals around you that want to work with the other professionals, right? People that are going to collaborate with your tax professional, collaborate with your mortgage loan officer, your attorney, the financial planner, the insurance agent, whoever it might be, right? Yeah. And buying and selling a house oftentimes can include a lot of those moving components, right?
Yeah.
You got to get the new homeowners insurance quotes and get that lined up and insured properly. You're going to need to deal with the mortgage loan officer. You're going to need to deal with the title rep. Possibly, depending on how complex of the deal is, getting an attorney involved sometimes to just review things, or the estate attorney, and making sure, the estate documents are updated properly, the financial planner, making sure that it aligns with, all of the plans, making sure it's not going to disrupt the cash flow projections, or making sure that the money's coming from the right spot, all of these kinds of things. So it takes a team sometimes when you're doing this stuff. And the more people grow in their net worth, the more that they absolutely need that team around them. So,
absolutely. Yeah.
Anyways.
No, thanks for being here.
Yeah. Thanks for coming on. Thanks for making the trip down south here to chat and take care of some business. So
congratulations on your success.
You too, Rob. Thanks.